Good morning. Hope everyone is doing well. Did you like seeing the snow out there this morning? I go swimming in a swim spa in my backyard almost every morning. And some mornings I have to shovel the snow to get there. And some mornings I have to shovel the snow off the swim spa, which was one of those mornings. But I still enjoy going to my swim spa. Well, welcome to today's topic. I'm Jim Barlow with OakTree Premium Finance. We're going to explore the tax-free concepts in this world. I usually start by giving you, oops, ahead of the game. Let me back up a little bit. Yeah, get to know what I'm doing. I usually start with a little bit about OakTree and Kaizen, my product, but I'm not today. I want to make sure we cover the topic, and I'll talk a little bit about that at the end as we have time. That's a big list, or I guess a pretty good list of tax-free investment approaches we have available in our country today. And I'd like to give you a view of all of them, and I hopefully you walk away understanding them, and it'll be helpful for you. Let's get started. Municipal bonds. Oh, wow, there's a lot of words on that page. I'm going to read them and kind of talk about it. Municipal bonds, often referred to as munis, are debt secured by local governments, cities, counties, states to raise funds for public projects. It's kind of a reciprocal agreement between these local governments and the federal government. Government bonds, U.S. government bonds, are tax-free, but municipal bonds, I think I just reversed that. Municipal bonds are tax-free, not taxed by the federal government, and vice versa there. There's two basic types. Good to know this. There's general obligation bonds, GO bonds, backed by the full faith and credit of the issuing government and repaid through the government's general revenues, including taxes. Typically used for schools, public benefits, infrastructure. These are your safest bonds. Very few municipalities go under. Some do, but very few. Then there's revenue bonds. Revenue bonds repaid from the revenue generated by a specific project or facility, not backed by the government's full taxing power. Commonly used for projects like toll roads, back east anyway, airports, sports facilities, and we as citizens vote for these revenue bonds, and they have to be approved by the where you live. These are a little more risky, and therefore they pay a little higher. Here's the basic rule: interest income from municipal bonds are usually exempt from federal taxes. If the bond was issued in the state you reside in, it may also be exempt from state taxes. And some notable states: Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming do not have state taxes. Some people move from wonderful Utah to Wyoming for Nevada for those reasons. Additionally, certain states have reciprocity agreements with others, further influence tax implications. In other words, if you have, I'm pretty sure Texas has reciprocity. Well, never mind. I don't know that list, but you'll have tax-free, state tax-free, and federal tax-free. But so municipal bonds are known that they're tax-free. Here's an interesting thing. Ross Perot, remember Ross Perot? did a filing. He had to do filings in 1992 when he was running for president. And this filing showed that about 8% of Perot's holdings were in U.S. common stocks. More than 3/4 were invested in bonds, mostly tax-free municipals issued by local governments. His estimated net worth at the time was $2 billion. I remember this very sitting down reading this in the paper and said, my first reaction was, Ross, what in the heck are you doing with that much municipal bonds? That's not the great returns that stocks can give you. Well, here's a commentary by Howard Stein. If you had a couple $1 billion, you'd do the same thing. A lot of tax-free income, rest and relax. And I remember after thinking that he was wrong, then I thought, oh, he's worth $2 billion. I get it. Why not? Less risk, especially if they're GO bonds. Just trivia, that $2 billion today would be about $4 billion. So municipal bonds are really good. I like them. I use them a lot as an investment advisor. One of my clients had a municipal bond fund that was high yield municipal bond fund. In other words, not only revenue bonds, but lower quality entities. And so it paid a higher dividend, and he loved this higher income. I couldn't get him to not have this mutual fund. And he just put more and more in it. A little bit like Ross Perot. Why not? All right. Municipal bonds. Got it? Now let's go to Roth IRAs. Roth IRAs are tax-free retirement savings. We're not going to talk about regular traditional IRAs, but Roth IRAs, the contributions involve after-tax dollars, meaning you didn't get a deduction initially, but the primary advantage is during retirement. Withdrawals become tax-free for individuals aged 59 and a half or older. Qualification for tax withdrawals necessitates the account be open for at least 5 years. Are taxes going up? Does the federal government owe a lot of debt? How are they going to pay it? If you think taxes are eventually going up, Roth IRAs would be a better option than getting the deduction in a traditional IRA. But there's some caveats. There's in the middle, the maximum contribution rules for 2024 are $7,000 per person. You and your wife could do in $7,000 each, and you have a catch-up contribution if you're over 50 each. So you're limited per year, and you're also eliminated by how much you make. So let's go over that married filing jointly. You get the full deduction. You can put the amount in if your income is over less than 230,000, but then as your income goes above that, you can't put it in. So above 240,000, that's not very much difference. Shoot, you can't contribute to it. So that's the issue. 7,000 a year, you might be knocked out because of your income. For years, as an investment advisor, I printed this tax reference sheet, and we always sent them out to the CPAs and the accountants in the counties. Scott, my son-in-law, who took over the business, changed the name to Plan for Wealth. He continues to print these. He liked them like I did. So if you would like a 2000 tax reference sheet, give my son-in-law a call. Scott Cheshire, Plan for Wealth. The phone number up there is 801-773-1644. We always refer to this a lot. So because these things change, the limitations. Now let's go to Roth 401k. it's like that Roth IRA. You don't get the deduction up front, but it's going to be able to take it out tax-free. There's limitations here. Up to age 50, you can put in $23,000 a year. Over age 50, you can put in $30,500. But there's additional problems with called top-heavy rules and restrictions. If the top-heavy, the highly paid employees in the company, they might be restricted on, and even had to take out some of their contribution. I did more than 1 year, and so you might get restricted at even putting in the 23,000. So Roth IRAs, Roth 401ks are a great opportunity for tax-free withdrawals in retirement. I like them. Health savings account. I hope you all know about these. Health savings account are designed for individuals covered by high deductible health plans. Contributions to a health savings account are tax deductible, offering immediate reduction in taxable income. Funds within the health savings account grow tax-free over time. And then as you take them out for qualified medical expenses, they're tax-free. You don't have to use them within a given year. You can build it up. When I was at Zion's Investments some years ago, I always did a health savings account, always. In fact, I was startled a little bit. I'd sit on my lunch break in our break room at Zion's Bank, Zion's Investments. I'd talk to other employees of the bank and say, "You participating in the HSA?" And most would say, "No, I don't understand them." Well, let me explain them to you, which I did. And I was kind of a fan, a promoter of health savings account. But you know what? Even after I explained them to a lot of people, they say, "Oh, it sounds a little complex, a little difficult to navigate." And I said, "Well, there's a little more navigation, but I liked them." If you have a health savings account available where you work, and you have any kind of health expenses, and who doesn't, in most families and issues coming up, this is a good thing to have. Okay, 529 college saving plans. I would say more people do this. College saving plan specifically tailored for educational savings, covering various expenses associated with higher education. The growth of the funds within a 529 plan is tax-free and provides withdrawals for qualified education expenses tax-free. So your growth is non-taxable as long as used for higher education. They're not tax deductible, but the growth is tax deferred. And as you use it for education, it comes out tax-free. You can pay the tuition. You can pay room and board. You can pay for books. I used a 529 plan for my kids. Another avenue to help save taxes. You do need to keep records if you're going to pay for books. You need to have that documented. No, which is, I guess that's a little complexity, but that's okay for me. Anyway, I like 529 plans. The state of Utah, these are usually sponsored by states, and the state of Utah has a great one. Less expensive, good options. Anyway, 529 plans. Yes, I need to mention this. Sometimes your scholarship might mess up your 520. Your 529 plan might mess up your eligibility for a scholarship. When you're applying for a needs-based scholarship and the university's looking things over, that you have to report these accounts, so it could be a problem. Every institution has their own rules. If you're sure you're going to my alma mater, BYU, then check with them. If you're sure your kids are going to go to Yale, then call Yale, see what they're up to. I have a grandson who's planning on going to Harvard. Hope he makes it. Coverdell Educational Savings Account. What? We got another education thing? Wow, complexity. You know what? I did really not understand Coverdell Education Savings Accounts until I prepared for this webinar. I'd heard of them, probably like you, but didn't know much about them. It allows tax-free earnings withdrawals when used for qualified education expenses. These accounts may be used to fund various education-related costs, tuition, books, room and board, for elementary and secondary and higher education expenses. That's the big difference here. If you're going to sending your kids to a private school that's very expensive, this is the plan for you. That for elementary and secondary. 529s are for only higher education expenses. Coverdell, it can go down to these elementary and these for expensive private schools. I didn't know that. I'm glad I do now. So I did a chart trying to put the criteria on the left, and the 529, comparing them, and which in each category I gave somebody a winner, and the winners are the green. So because the Coverdell covers K through 12 and higher education, I gave them the plus. Contribution limits. Oh, I forgot to tell you, mention that. There's a contribution limit on the Coverdell. That's a problem. So the 529 one there. More flexible in your investment options, although Utah has a great one, 529 plan. Expenses, as I said, primary, elementary on. Anyway, if you private school, you really want to consider this Coverdell. Anyway, I had fun putting that chart together. Hope it's helpful. 529 Able. Wow, you know what? I hadn't heard of this either. Sometimes doing a little homework and researching is good. Able stands for Achieving a Better Life Experience. Designed to empower financial independence for individuals with disabilities. So if you have a child with disability, this is a way to get some expenses paid for tax-free for their care. Number 3 bullet point, contributions 529 ABLE accounts are made with after-tax dollars. Unique feature is that the funds can be used for disability-related expenses without impacting eligibility for other means test government benefits, Medicare, Medicaid, supplemental security, Social Security, things like that. Another niche area, but good to know. Charitable contributions. Probably a lot of you understand this concept. Charitable contributions, making charitable contributions to your church or to Red Cross or Davis Arts Council that I was on the board for many years. Anyway, they're tax deductible. And so this is being generous and helping causes gives you a tax benefit. I would like to focus a tad on donor advised funds. I've used these. is a subcategory of charitable contribution because let's say you just got a giant tax bill. You're in December or November. I know I'm going to have a terrible tax year. Well, then you can put money into donor advised funds, making your charitable contribution right now for maybe next year. And then you can divvy out the money from the charitable donor advised funds to the charity of your choice. It's just a strategy to do it quicker, or just control things and have it grow in there for a while. So I like charitable contributions. I like using donor advised funds. Life insurance. This is the Kaizen area, so this is maybe I have a biased area here, but life insurance policies offer more than project protection. They can be a versatile financial tool with tax advantages. They accumulate cash value. Certain types of life insurance, you can see I'm trying to be fair in the wording, not overly biased, such as whole life, universal life, index universal life, accumulate cash value over time. The cash value grows on a tax-deferred basis, meaning the policyholders do not pay taxes on the growth until they access the funds. Now, tax-free death benefit. The primary purpose of life insurance provide a tax-free death benefit to beneficiaries upon the policyholder's passing. So you've used the cash value life insurance, you've overfunded it, and it's grown to more than you put in, let's say by 500,000, and then you haven't paid taxes on the growth of 500,000, and then you die, it goes to your heirs tax-free. Let's go to the next slide. Tax-free withdrawals or loans. Some life insurance policies, I do these hedge words because I think compliance likes it. Some life insurance policies, particularly those with a cash value component, may allow policyholders to take tax-free withdrawals or loans against the cash value. That's what we do in Kaizen to give you a tax-free retirement income. We borrow from the policy. The leverage, the borrowed money, is a plus for you forever. It's essential to understand the term and conditions of the policy. Consult an advisor like myself if you're listening to this from wherever. Using these concepts in the Kaizen and the borrowing is amazing. I love my product. I think it's a solution for a lot of issues in life, to make life better for a lot of people. So I like the cash value life insurance. So let's see how we doing. Well, we've done pretty good time-wise. I hope I haven't gone too fast. Let me see if there's questions. Not yet. Okay. Here's the areas we've covered. These 5, kind of in the middle, are things you should, if you definitely consider and place into your plan. You have a health savings account available at your employer. Oh wow, do it. If you have a 520, do it if you got saving money for college education, 529 plans, Coverdell education savings, do it. 529 able if you have disabled children, do it. Charitable contribution, oh well, I guess you don't have to do it, but you can help charitable entities with not a lot of pain on your part by helping them. And then that's the 5 that have nothing to do with retirement. The other 4, I would say you could use these for retirement. municipal bonds, Roth IRAs, Roth 401ks, life insurance policies. So let's talk about the disadvantages for those four. Municipal bonds, lower returns, interest rate risk. Interest rate risk means that as interest rates go up, the value of a bond goes down. It's a fascinating thing. In my career as an investment advisor, what clients got mad at me the most? But not that I'm telling you they all got mad at me, but it's the bond investors, the more conservative investors. When their bonds went down in value, that disturbed them. Um, I need to continually educate them and explain how bonds operate, that there's interest rate risk, but it was the conservative investors that usually got more anxious than the stock investors. That's fascinating. Lower returns, interest rate risk. Roth Perot, great option. Roth IRAs, they're good. I would, if you're eligible, I would absolutely do a Roth IRA. That's a good source. Let's jump over to Roth 401ks since we're talking about before we go to life insurance. So the same issues with Roth IRAs and 401ks is these contribution limits and income issues and the top heavy plans, and your employer just might not have a 401k or a Roth 401k. They might not offer it. I would say in today's day and age, employers should offer something for retention and for people's retirement, but they don't always do so unless it's life insurance. What's what's the slam there? Well, cost, complexity. Well, darn. The complexity part, I would agree, but I've worked hard to understand them and try to be able to explain how these things operate for people. The cost for the initial years is expensive because you're buying life insurance, but down the road, wow, this will become less expensive than your other investment accounts. About half, less than a half a percent. That's probably another webinar. So that's kind of the information. Let me check questions. That's kind of the information I really wanted to cover, and I'm glad I did it in a pretty short time. So here's my information, and there's the QR code. The purpose of the QR code is if you'd like to learn about Kaizen without having me disturb you as you read about it and watch a video on it, this is a good source. Go to take a screenshot of the QR code and you'll get a pretty good feel for Kaizen or a beginning feel. Now I'd like to, especially since we made it in good time, I'd like to get into a little bit of Kaizen. I always show this slide. These are the ways Kaizen can be used. 6 out of the 7 are Kaizen. The gray traditional premium finance is not. That's where we started in this firm, OakTree Premium Finance, and still it's one of the slices of my pie, but it's not the most important at this point. Kaizen can be used for retirement income. That's its number one use. It can be used for transferring wealth, gifting strategies. It's a great way. It can be used as a fixed income alternative. I don't like those bonds. It can be used as an executive employee benefit plan. It's a really good one in that area. It can be used for a buy-sell succession planning to keep a company afloat and when there's more than one owner and things change. Or you could just use it as a key person protection within a company. Can't be used for everything, but that's some pretty good areas. I put this chart up about every month, and I've changed it a little bit this time because I want to add in some, see those blank spots I've added in some, I'm going to show you the negatives, a little bit of Kaizen with those in a second. But let's go over the key features and advantages. So potentially tax-free withdrawals, access to cash value using tax-free policy loans. I mentioned this. If you can get your money tax-free, eliminate tax risk, that's like getting a 33% increase in your return. That's important. Second, no negative returns, zero floor. This is in an index universal life, the way it's designed, and maybe we should do a whole webinar on this, is no market, you can't have a less than a zero. Eliminates the downside market risk. 3, upside crediting, exponential growth potential. This is tied to number 2. They have this, I don't want to get into detail, but you have a premium, you have a option account premium money that you can buy options on the index, the Standard & Poor's 500. If you do a capped index within this, you're going to have a cap. Let's see the 12.5 example. And if the market averages, if the market has a 14% year, you're capped 12.5. In this example, the cap changes. This strategy has averaged 8.2 in a lot of policies. I probably should specify that a little bit more. What I really like is the participation indexes. And one of them, in Allianz, they have a Bloomberg US Dynamic Balance 2 ER index, mouthful. This index has averaged 5.4 over 10 years, but currently you get a 218.5% participation rate. You get more than 200% of that 5.4. So this one's average at the 218.5, 11.88. No caps. I like that. So reduce market volatility and investment risk. Big plus. 4, leverage maximum funding up to 3-to-1 without collateral, personal guarantees, loan documentation, interest payments, credit checks. Substantially reduces capital risk. You don't need to worry about the interest rate market and the market so much and losing with, because you don't have to do collateral. This leverage is a big deal. It helps a whole lot. 5 annual payments, reduce payment fatigue. And one company now has a monthly payment program. And last, the first kind of reason you buy life insurance usually is the death benefit and living benefits. But the living benefits are terminal illness, chronic critical illness, critical injury. This is like buying life insurance with supplements for disability insurance and long-term care. Those are big deals. Years ago, I bought a long-term care policy, very expensive. Most people can't afford those today. A lot of companies don't issue them today. Eliminates financial vulnerability risk. But I added the disadvantages. So the potential tax-free withdrawals, long-term commitment. If you can't handle that long-term commitment, then you don't get the tax-free. No negative return years. There's going to be some years of possibly lower than market returns in certain economies. No negative years, but you'll get some zeros. 3, upside crediting, another long-term commitment, possibly lower the market returns in certain economies too. Leverage. Leverage always carries a risk spread from what you're making to what you're paying in interest. That's called the risk spread. Interestingly enough, Kaizen, looking back testing from 1930 to today, they've never seen a 15-year period of time with a spread less than 2%. Wow, if I can guarantee on borrowed money 2% long term, that really is a winner. Anyway, um, probably getting out of order now a little bit, talking about too much. 5 annual payments, I already mentioned that. Financial capacity, can you do it? Death benefits, again, life insurance has higher costs in the early years because of the life insurance. I hope that was helpful to add those. Here's the little visualization on the leverage. I like calling it the seeding. You have 5 annual payments, and the bank has usually about the same amount, similar amount, 5 annual payments with yours. Then in the next 5 years, you have 0 payments. You're done, but the bank continues to make what they were paying for the first 5 years, but they also are paying what you were paying. So that's where we kind of get the 3-to-1 leverage. I usually show this. I've changed it a little bit over the months, but the toll bridge of Kaizen, the qualifications. First, the ability to make annual minimum payments ranging from $20,000 to $40,000. Capacity, got to have some money to put in. Growth period, you need to give this some time. It needs, the bank is putting in money through 10 years, but we need more than that. We need 15 years to give this some growth time. And from our back testing, we've seen that 99% of the time, we're in a position to pay off the bank in 15th year. Eligibility, financial eligibility, you need to have a minimum net worth, usually of 100,000. Some carriers require more net worth and different net worth requirements and different things. Then we have the health underwriting. You need to be standard or better underwriting. And then the age is 18 to 65. If you're over, you can't have it. This is important. Let me jump ahead a second. Just this morning, this is, maybe you can even tell that I typed this out today because I did. I was thinking of doing a future webinar would be called "Is Not for Everybody," and I listed the 5 major reasons that not for everybody down below. Qualify, they got to qualify insurance wise. Resources, do you have the money to put in? Do you have the time to let it grow? Do you understand this? And can you weather through can you endure it? Using AI, I put those things in and came up with this acronym, TREE-CQ. Well, I like the tree because of OakTree. So this prescription is TREE-CQ. Time, resources, endurance, comprehension, and quality. Just change the order of the 5. With TREE-CQ, you'll secure a prosperous retirement, enjoying increased income, experience exponential growth, benefits from tax-free earnings, shield against downturns, and achieving market-like performance. Plus, expect minimal side effects. I'm probably going to work on that some more, but that was from thinking this morning. Let me go back to this one. I modified this over the time, but notice my suggested ages. The big deal is the yellow. If you're younger than 50, Kaizen is it. It works like a charm. You've got sweet spot is under 50, and 51 to 64. Now 65 is over; you can't buy it. But so 51 to 64, we're going to look it over and see if it fits. One, you got to give it this 15 years. If you're 64, looking at it, 74, 79, do you really want to wait till income is 79? So, unfortunately, there's this time situation, age situation. Now, down at the bottom, I need to mention this: in transferring wealth, gifting, the receiver, let's say you're gifting this to your 25-year-old or 45-year-old daughter or son. Well, they have the same rules as the receiver, but we have some additional rules as the giver. If you're over 55, no restrictions. If you're younger than 55, you must own Kaizen on yourself. Interesting enough, I actually sold one to a person, the giver under 55, and I did a cover letter to the insurance company explaining why we're doing it and why we would like them to consider issuing it. They actually said no initially, and I told the client, no, they're not going to do it, not willing to do it. But they reconsidered in the next couple of weeks, and we got it issued. Anyway, that the age is important. Now, there's my tree CQ. Let me know if you like that one, that idea. We probably have gone long enough, but let me, I'm not going to go to the ILIA today, but we have this interactive learning information assistant landing page that you have to have a login and password to go to. I can use it with clients. I'm a sponsor, one of the sponsors of it with Kaizen. And in this site here, on the left, you've got a lot of information on Kaizen. And I put it on the estimate my benefits. You've got this quick estimator and the custom design. This is really a big deal. A great help to me for you and for my clients. If you have not already been invited to ILIA, I can send you an invitation. And once you're invited, you can select a password. You can select a login and a password. But the information I need to be able to send you that invitation is name and birthday, mobile phone number, email address, and we have to make a carrier choice. I'm not going to show you those carrier information today. We can do it over the phone. And there's places for me to put your expected contribution, combined annual household income, net worth, occupation. But I didn't bold those because I can guess on those and send you the invitation. You don't have to disclose the whole world to me. But birthday, mobile phone, email address, those are essential. And we had this last webinar, but this was, let's see if here's this, I did an ILIA illustration on a male person age 40 with excellent health, non-smoker, with a contribution of $70,000 a year for 5 years. The reason we chose the 70, that's actually the average in the US of people buying Kaizen. They don't, very few go with the minimum, some do, but that's the average of what people are contributing. So in this case, 40 years old, there's 70,000 contribution by him per year, 350 over 5. Then the bank is putting in 73,122 over 5 years, 365,610. Then the bank is putting 141,773 for the next 5 years, 708. So the bank contributes $1,074,000, and add that to the 350. We have a total contribution of $1,424,470, and the initial death benefit is $2,004,000. This illustration is illustrating a 6.71. Is that a good return? We've averaged about 8.5 on Kaizen, but I don't want to show people the highest return. I think that's a fair number to show you illustrations. After tax, it'd be if you're paying an investment account, it'd be a 20% long-term gain, and 5% you'd be making 5.02 on the 6.71. There's interest rates that you're paying, and the rates, as you are well aware, are higher right now. The initial year, we're illustrating 7% higher than the 6.71 we're showing that you're making. And we're projecting rates over the next 15 years of 5.15 to 5.7. I listened to an economist the other day, and he was saying that he thinks that Fed will start lowering rates mid-year. That is, they've already hit the cap. It's not going higher. Remember I talked about that 2% spread, and there's a little comment about it. These illustrations are illustrating 0.6. We've never averaged less than 2, but we're illustrating 0.6. So we're not showing you what we think is going to happen. We think this is kind of a worst case situation. Now I can go back to this. This is the illustration that the insurance company and Kaizen puts together. It shows you your 70,000 contributions, shows the bank contributions, it shows the growth of the account, it shows the interest rates you're paying, it shows the withdrawals down the road. Notice the 203,000 on the far right, down at age 65. Anyway, it's showing everything. And I worked on a spreadsheet to just modify it some and make it a little bigger print, as I called it. I've noticed, first line is at 5 years. I cut out the first 4 years, then I cut out the next 4 years. So I'm showing less years. But the royal blue is right off the spreadsheet. The age, year, column C, E, F, H, J, K, and the navy blue columns are just arithmetic, just adding up columns to show a little more where you are. And now on the green, these are calculations comparing growing after tax account, this same return if you did it outside of Kaizen. And I want to show you this for a second. So notice the 350 at the end of 5 years would be at 387. And go way over to column H, the Kaizen would be at 308. You mean I'd have been better off just investing in this return in the market than Kaizen, that I've lost? What have we got, about 80,000? My answer is yes. Where'd that 80,000 go? Went a lot for life insurance. There's this life insurance is expensed high in the early years. Let's check. So I put the Kaizen a negative number, 308. Now let's look at 10 years. The 350 would grow to 494, and in Kaizen it'd be 401. Ooh, I got to put a negative there. We're still, what, about 90,000 behind. And now I did 13, 14, 15, 16th year because we actually changed over. So 13th year, where 350 has grown to 572, and then the Kaizen would be 554. Ooh, it's getting closer. Oh, did I 601 to 620? I read the wrong columns. Well, anyway, there's a crossover, and that Kaizen starts to grow faster because of the tax-free, because of the leverage. And so notice the investment account is going to be read for evermore. And let's go through age 65. The investment account has grown to $1,030,000, and the surrender value on the Kaizen, column H, has grown to $1,608,000. We're ahead roughly 600,000. Wow. At age 65. This is a lousy short-term investment. Lousy. But as a long-term investment, it's terrific. And then we start paying income. What we're doing on the investment account on the side is we're going to target this to be out of money at age 100. That's probably the oldest everyone's going to live. So that 63,102 is staying at the same rate, but we're using every penny to give you the highest income possible from this original 350. So what's the income on the Kaizen side? 203? 63,000 to 203, and where spread was 0.6. This is not even reality. What is that? 3 and a fraction higher return? Would that make a difference? 63 to 203? No downside, tax-free, good potential. I love Kaizen. The beauty of Kaizen is in the leverage. I know, borrowing money. Column F, let's go to age 100. At age 100, this account's worth $41,220,000. And if most of that is debt, that surrender value next to $1,772,000 is the actual investment. There's a death benefit, $2,339,000, but the debt, if it's averaging 2%, that's why I could give that 203. The leverage, the borrowing, is what makes Kaizen hum. I love it. Well, I did this chart last month too. So maybe you weren't excellent health, 40-year-old. Maybe you're a smoker or whatever. So I did. There's your 203, excellent non-user. Well, if you're a smoker, then it's going to be 154. If you're average, well, I mean excellent average health non-user, 154. Excellent health user, 120. Average health user, 107. Female, there's the numbers for female, but all those numbers are higher than the 63. So even though you didn't get the 203 for whatever reason, you're still better off. And even if we stop the income at age 90, it'll be at 73. Kaizen works for those who qualify. That's it for today. Let me look. I didn't want to do any illustrations. No questions today. Okay, that's good. I've enjoyed talking about these tax-free avenues. I hope it's helpful. I'll have this posted on our website. So if you want to review this webinar, you can. We'll do another webinar next month. And for that, have a great day. Talk to you later. Bye.